Right, what's up everyone and welcome to the Magnus Capital Futures trading strategy video. In this video we're going to be breaking down the strategy we use, our kind of entry model that we framed together using key concepts, why we take it, what we look for, and yeah, just going to be going through some chart examples as well. So before we do start, we just would like to say as well that we do use a series of concepts derived from ICT. These are often called smart money concepts, and we use these in confluence with each other to form top tier entries, which we've used to create our own kind of model that we go off. However, not every single trade will present each of these confluences, but we do look to align as many of these confluences together as it provides higher confluence and a stronger faith in our entry. However, we do avoid analysis paralysis with hundreds of lines on the chart, and we don't use indicators. Also, by this we mean we don't kind of scale through every single time frame looking for every single confluence to align, as this will kind of, well, it will frazzle your brain, make you confused, and it will also make you miss a whole bunch of A plus setups as well, because not every single thing is going to align on or appear on every single time frame. Also, if you're new to this, you won't just get it, like you won't just be able to watch this video, hop on a chart and use our kind of concepts and strategy, as this has taken us years of effort on the charts to be able to just open trading view and be able to scale through timeframes and just frame our entry model. And our model bets on a mixture of reversals and price rebalancing as well as price continuations. The concepts that we use can be used to catch a reversal in price, aiming to mitigate liquidity, and a rebalance in price after strong trending low time frame price legs, or look for fills to catch a continuation long or short. So, what are the concepts? So essentially, these are the concepts that we use in confluence with each other to form a top tier entry, and essentially this is what we kind of aggregate together to make our sort of model. So when we open the charts, straight away we want to outline our draws on liquidity. Where do we want to see price gravitate towards? Well, normally one thing we love to see is trendline LRL, because it essentially allows us to bet on a sort of mitigation of that low time frame grind up, that we essentially want to see price mitigate all those buy stops or sell stops depending on the direction they're in. Another thing we like to mark out or like to see price gravitate towards is previous day highs and lows, previous session highs and lows, and of course there are other draws and liquidity that form throughout the day. You've got equal highs and lows, you've got data wicks and stuff, but these essentially form throughout the day as price action develops and throughout New York session. This is essentially when we just jump on the chart waiting for New York market to open. We also like to mark out potential low time frame barriers or higher time frame, of course, if you trade on the 1 minute, that could stop price trading towards full TP depending on the direction. These essentially form as kind of 3, 5, or 15 minute PD arrays or imbalances. For example, if we're looking for a full mitigation of an LRL leg and we see a soup at the high 1 minute inversion, CISD, whatnot, but then there's a 15-minute gap between current trading price and TP. Again, we would love to go break even before that level in case price does reverse and stop us going, obviously mitigating the whole leg. Another thing we love to see is a turtle soup, so essentially a sweep or an SFP of a key area of liquidity, failure to displace above or below it, and then obviously a reversal which can be used in confluence with an IFVG. These work great in confluence with SMTs with ES, but of course SMTs are a bonus. So essentially an SMT is when one pair takes a higher or low and the other pair doesn't, indicating that there's a complete lack of momentum and price wants to reverse. These obviously are extreme great added confluence if they take place in a PD array. So let's say there's a soup and an SMT inside, so price is traded up, let's say into an hourly gap. We see a soup and an SMT, again, just amazing confluences, but again, you don't need all of them to appear for it to be a great setup. So we love to see delivery from a PD array with a sweep or a soup, but a PD array is a strong bonus. Again, another thing we do look for or kind of use for confluence if we are looking for price to see a surge in volume towards key levels is the macro. So this is essentially where time and price align. This is a bonus but can provide key liquidity volume to allow a thesis to play out. For example, the 10 a.m. reversal after a higher time frame 9:30 open Judah swing, and essentially this could then also play out as a silver bullet style model. If let's just say 9:30 open, Judah swung higher, baited in longs, and then essentially the 10 a.m. macro came. We saw the soup, inverse for value gap, and then a silver bullet after taking out external range liquidity, and silver bullet all the way back down to further external range liquidity, such as like previous session low. 9:30 wick would be an internal draw and whatnot. Another thing is CISD or change in state of delivery, but this depends on how far price is looking to rebalance. For an example, let's say we're trying to target a 100-point move, then it's definitely a great added confluence. But if we're looking for a small blip kind of reversal or momentum trade, it's not really something that we really kind of bet on there being, especially if price is trading through one or two strong candles, trying to mitigate through a huge imbalance. And also, it's great to see if price is trading extremely premium or discount, or trading into premium or discount after a rebalance, as this could cause for a continuation trade. And also, one final thing, if betting on a continuation trade is if price is trading within OTE, so that's normally between the 0.618 and the 0.786 Fibonacci retracement. So what would be our ideal scenario? Again, this is just an example, but funny enough, this is more or less exactly what played out on Friday, which was the last trading day and also the first trading day of the new year. Again, before we get into this obviously is just a top tick example, like everything goes the way we want it to, and this could also work as the reversal when looking for longs rather than shorts. So essentially, we'd like to see price trending bullish through London, leaving behind low time frame LRO or low resistance liquidity, building up as price trends higher, making longs essentially seem too free as price is extremely premiumed, which means we're trading above the 50% consistently, leaving behind London's low and also Asia's low as the final draw, depending on if London mitigate it first before trending higher. We'd like to see price trade into a high time frame PD array and soup a previous high with a failure to displace above it. A bonus is an SMT, with ES failing to take out the same high, or NQ failing to take out the same high that ES did, again displaying a lack of momentum. Ideally a 1 and 2 minute, or either's fine, but a 1 and 2 minute IFVG with a strong displacement to the downside, indicating after the SMT and the soup, price's desire to rebalance lower, and TP would be well into discount of the leg, as we'd be looking to mitigate the trendline low resistance liquidity. But again, depending on how far we disrespect imbalances that are in the premium range of this leg, such as 3 minute, 5 minute or 15 minute gaps, you could TP much lower and essentially aim for previous session lows, previous day lows. But obviously, again, it depends how far and fast price were to completely disrespect these gaps. The soup could play out as a Judas swing at New York Open to bait longs in and mitigate an untapped high with a failure to displace above it, then see the strong sell side move to rebalance price and mitigate unfilled inefficiencies from free longs essentially during the previous session. As we mentioned before, this also works as reverse when looking for longs. So let's take a look on the chart and put this into an example, and as we mentioned, funny enough, this is exactly what played out on Friday, which was the last trading day. So essentially, this is what we ended up seeing on Friday, which was the last trading day, and more or less it was pretty textbook. Again, this move would have been a nice 233 point move if you caught the whole thing, or if you TP'd completely at the bottom. But again, if you follow the strategy 1 to 4 risk to reward ratio, a lot of people, again, they'll come on here and use things like FX replay or trading view replay, trying to find the most picture perfect textbook setup. But the thing is, this is actually the last trading day that we actually had, and funny enough, our setup played out perfectly, right? So what happened? So as we mentioned before, came on the chart, cool. If we just go on the 15 minute, right? So this was Asia Open, this is London Open, and essentially, as you can see, the daily open gapped straight up. The CME opened, gapped straight up, and all the way through Asia, and more or less about halfway through London, price was trending extremely bullish, right? There was little to no pullbacks, little to no mitigation of this leg. Price was extremely premiumed, right? There was no mitigation of any major imbalances. Cool. As we neared pre-market with New York, we ended up seeing a small pullback into some of these gaps here, this 15-minute gap here. If we go on the 5 minute, we can see the New York market opened, fine. We failed to mitigate London's low. We Judas swung higher right into this hourly gap that price had been respecting the whole week. So as you can see here, Monday, price kept sweeping into it but failing to displace above it. And so then cool, what we had was, it was a mitigation of this hourly high, right? So as we mentioned before, a sweep with a failure to displace above it inside a PD array. So we had a turtle soup, fill of a PD array, and also, which was added confluence, we had a bearish SMT with ES, meaning that NQ took this high and souped it, and ES didn't, which was great confluence that obviously market wanted to mitigate a lot of this buy side leg here. So then what did we see? If we scale down, so essentially again, Judas swinger open into an hourly PD array, failure to mitigate above it, total soup of that high, bearish SMT. We had a 2-minute and a 1-minute IFVG with pretty strong momentum straight through it, as you can see on both time frames. Yep, here, and then basically we would have gone, or if you were trading this, you would have gone break even here at the New York low. But also here, if you were trading this normally, you could have TP'd fully at London's low, which would have been a nice, like a pretty clean 72 point move. But the thing is, as we mentioned before, you can expand your TP, obviously not financial advice, depending on how strong the move is, when obviously you're looking for your trade. As we said before, how do you judge that? Well, it's disrespect of imbalances, right? Oh, sorry, ignore that. Right, so as you can see here, this 15-minute candle absolutely slammed through this 15-minute gap, inverting it. So now not only do we have this confluence here and these lower time frame inversions signaling a low time frame shift in momentum, we've also taken out a key external draw, which was previous session low, and made a 15-minute inversion and disrespected it solely by completely closing below it. Again, as you can see here, well, if you had left a runner at London low, you could have TP'd fully at Asia's low, as the next 15-minute candle absolutely slammed through it and mitigated more or less all of the daily leg that had built up. Absolutely picture perfect trade, beautiful trade, delivering from a high time frame PD array. All of our confluence is playing out. We've got the CISD here, and yeah, absolutely 10 out of 10. Right, so just again some key points here. Not all confluences must appear for you to take a trade, but of course more and more appearing will give you that added confluence and kind of faith in your trade. But the thing is, price may end up front running key levels. For an example, price may like leg up, rebalance higher, not tag into a high time frame PD array, but completely disrespect the nearest imbalance and basically bet on a short term reversal. So the thing is, you don't want to get too married to the idea that every confluence has to be aligned for a trade to take place. Of course, the more that line up means the more textbook and kind of golden the setup is, but you shouldn't be held back by not every confluence appearing. Your draw and liquidity must be clear and doesn't always have to be a huge pip move like Fridays, for an example. Obviously, another example here, there could be equal highs and lows above or below after seeing a sweep of a wick, and 1 minute IFVG with strong momentum could be a cause for a good scalp, normally maybe a 15, 20, 30 pip scalp there. Prices also won't always deliver to a full TP in huge trades, so it is important to break even at internal range liquidity to avoid damaging your profits and your win rate. And if you are betting on a continuation trade, you do want to see imbalances that align with your bias get completely respected, and as well as protected high and lows completely respected. Right, so as we mentioned on the last slide there, here is an example of what we were talking about, where not every confluence will have to align. So the thing is here, so this was actually on New Year's Eve. This was a continuation trade example. As you can see here again, pretty textbook. London rallied up here. We had all this low resistance liquidity building up. Souped the high. New York came in, completely disrespected all of that. Ended up making New York slow. And then we saw a rebalance of over 50% of this sell side leg here. But then the thing is, if you were looking for a fill of this bearish 15-minute gap, which we had earlier, bearish retest, there's a potential that you could have completely missed the trade as price front ran this. So the thing is, not all confluences have to align, because the thing is, although we didn't tag into the 15-minute, we did see some pretty textbook things. We did see a CISD. We did see a strong, very strong 1 minute bearish inverse fair value gap, and then obviously clear targets here. Draw on liquidity would have been obviously this low resistance liquidity, this buy side with current session low that would want to get slammed through. So again, don't like, if the setup appears and you have your clear draw on liquidity and other confluences are at play, don't like not take a trade if you think, because not everything is ticking the boxes. Again, a lot of these trades bet on shifts in momentum, so if that does appear, then obviously be prepared to kind of be agile in the market and adapt where necessary. Right, so just again quickly going through that, price left behind strong LRL after a huge trending move during London. New York opened, souped the high and mitigated the leg as well as London's low. Price then saw a 1 minute inverse fair value gap and soup, which fueled a relief rally to rebalance, which was over 50% back into discount, the sell-off, and mitigate low time frame inefficiencies. Price failed to tag the 15-minute bearish gap on the rebalance leg and left behind trendline LRL from buyers betting on a strong CISD after taking out previous session lows. There was a failure to displace into the gap and soup the old high on both pairs, ES and NQ. 1 minute inverse fair value gap and TP would have been at current session lows. Again, this is proof that not all confluences have to appear to take a trade in good conditions, as long as it aligns with your bias. Right, so just before we wrap up the video, again, a lot of these terms may be new to you guys, you may not know how to use them, so we'll just quickly cover them with a brief explanation. So an SMT divergence is essentially a momentum indicator, obviously not an indicator that appears on the chart, but it indicates a shift in momentum, and we use them to compare ES and NQ, or S&P futures and Nasdaq futures. For an example, one may soup a previous high or low without the other doing the same, signaling a potential shift in momentum. Again, these can be used in confluence with IFVGs and basically frame the whole entry of your trade. Liquidity is what drives price, and understanding draws on liquidity in different market environments will allow you to TP at the correct levels without getting stopped break even, as well as having the correct bias going into the trading day. Also, understanding that price moves between key external liquidity points and using internal range such as PD arrays and highs and lows as fuel. It's good to understand these to mark the correct break-even levels, as well as higher time frame imbalances that price may struggle to disrespect that can completely damage your trade, but can also be a reason to size up, obviously not financial advice, if these are disrespected and you're aiming towards a full TP. Turtle soups are essentially liquidity sweep, or SFP, swing failure pattern, indicating a failure to displace above a key level or below a key level, and a potential shift in low time frame direction could be inbound. IFVGs, or inverse fair value gaps with strong momentum, are one of the strongest indicators of a market's desire to reverse and rebalance, as price didn't respect its most local imbalance or inefficiency, and orders on the other side of the book significantly outweighed any resting ones in the PD array that would have allowed for a continuation in bias and trend. Simply understanding if price is heavily discounted or premiumed obviously depends on either betting on a rebalance or a continuation trade, and aligning this with key draws and liquidity for a rebalance or distribution leg can give a huge edge. Being able to spot this and then spotting a slow momentum after a strong directional skew can provide huge returns if the draw on liquidity is correct. Again, it is important to understand fibs for premium and discount and OTE, as we mentioned, which is the 0.618 to the 0.786. A CISD, or change in state of delivery, is a great added confluence as price shifts structure below or above key levels in price. And the macro, as we mentioned, falls between the last 10 minutes and the first 10 minutes of the hour, and can be a great time to assume a reversal or a continuation if price is heavily skewed in one direction, as it typically one of the most liquid times of the session, as this is when most large settlements from TradFi take place. And so essentially, if you are betting on either a continuation leg or a reversal leg, obviously looking to mitigate a large amount of liquidity, you can presume that if price is stalling and about to trade into one of these macro time periods, let's say from 10:50 to 11:10, you can assume that obviously there's going to be a liquidity injection, there's going to be a huge amount of settlements for TradFi that could allow your trade to obviously gravitate towards TP and kind of mitigate those lower time frame inefficiencies and imbalances. Right, so that's the end of the video. Just a quick kind of short video summarizing our strategy. Obviously a lot more does go into it, and we have had years of chart time obviously perfecting this. But if you do have any questions, do drop them below, and don't forget to like and subscribe. And if you do want to join our free Telegram, where we do post absolutely everything to do with crypto, TradFi, trading, macroeconomics, just basically absolutely everything, where we post our trades, all this sort of stuff, it's completely free. Drop a comment and we will send you the link. But yeah, thank you very much for watching, and see you in the next video.
See you in the next episode. Magnus, out.